Welcome to Accounting 101. On this lesson, I'll be continuing with the elements of financial statement. On the previous lesson, I was discussing, or rather, I presented a lesson where I was talking about or giving definition to an asset, liability, and equity. So on this lesson, I'll be talking about income and expenses or expenditures. Let us begin with the definition of an income. An income is an increase in economic benefits. So by that, we are referring to an inflow of cash that will increase what we call an economic benefit in such a way that we are able to receive more amounts of money through this particular income. And this particular income is what we call positive effects towards the operations of the business because we are receiving an amount of money. So it's also during the accounting period. So it can be measured or recognized or clearly identified or estimated during a financial period. So the third part of this definition says, in the form of inflow or enhancement of assets. So this particular economic benefits can be in the form of an inflow where we receive an amount of money, but also it can be an enhancement of an asset or a decrease in liability or liabilities. If they are referring to an income in a form of a decrease in liability, they are referring to a liability. They are referring to, for example, the issue of discount received. If we receive an amount for discount, that means our current liabilities or our account payables, they do what? They will decrease. So that is what they are referring to. And the last part, resulting in an increase in equity. So if we are talking about equity in this case, we are referring to an income. You are referring to a profit that is generated from the beginning of the accounting period until the end. So here we are looking at an increase in terms of net profit, but excluding contribution from participants or from the owners of the business, excluding capital. Then lastly, let us look at expenses or expenditures. A decrease in economic benefits. So by this first part, you can tell that expenses are an opposite of your income. So if you're looking at a decrease in economic benefits, we are looking at a decrease with regards to the inflows that we are able to receive. Your profit is being reduced, and all benefits that we were enjoying economically now, once we have an expense will have a negative effect towards your economic benefit, and that particular expense should happen, or this particular decrease in economic benefits should happen during the accounting period in the form of outflow. So, and it can be regarded as an expense if at the end of the day or at the end of the month we are making payments. We regard it as an expense because it is a form of an outflow or a depletion of assets. For example, in this particular case, depletion of assets, we are looking at a reduction of assets in such a way that, for example, if you had an asset, now you are calculating depreciation, even if there is no outflow of cash per se, but that reduction, but that diminishing value that we call an expense, and the account for that is depreciation. It's also regarded as an expense because an asset is losing value, an asset amount or historical cost, or rather a book value, is being reduced through depreciation. Then they say, or increase in liability. So if they say an increase in liability now, they are referring to a situation where we have borrowed an amount of money, then we are making payments of, let's say it's a loan, then we are making installments as per the loan liability, but also we are making, or rather we are being charged what? An interest. That particular interest, we refer to it as an interest in expense or interest expense, simply because a liability is being increased. Or rather, we are not paying as per the agreement with regards to our creditors, then they add some charges as a form of penalty. Since we are not paying, then also a liability is being increased, and that particular charge we refer to as an expense. Then lastly, resulting in a decrease in equity. So the more expenses we have, the less profit we are going to make at the end of the financial year, or any period that you want to use as a measuring stick, simply because you are having more outflows than inflows.